This is the third in a series of pre-lecture videos on exchange rate determination for the course Global Business Economics. I'm David Frankel, a professor at Melbourne Business School. Before watching this video, you should watch the prior two videos in this series, which are titled Exchange Rate Concepts and Exchange Rate Determination Part 1. In the Exchange Rate Concepts video, we learned that there are three types of exchange rates. The nominal exchange rate between the Australian dollar, or AUD, and the US dollar, or USD, equals the number of US dollars that you can purchase in return for one Australian dollar. The real exchange rate equals the cost of a fixed market basket in Australia in US dollars divided by the cost of the same basket in the United States in US dollars. The purchasing power parity, or PPP exchange rate, equals the cost of the US market basket in US dollars divided by the cost of the Australian market basket in Australian dollars. In the exchange rate concepts video, we also derived a key equation that the nominal exchange rate equals the product of the real exchange rate and the PPP exchange rate. In the second video in this series, we learned that there are four theories of how the nominal exchange rate E is determined: the PPP theory, the demand for goods theory, the demand for assets theory, and the supply of assets theory. In this video, we will delve deeper into the demand for assets theory by developing an economic tool that is called the Uncovered Interest Parity equation. In the last part of this video, we will combine that equation with the PPP theory in order to derive some additional useful implications. The demand for assets theory states that a country's nominal exchange rate depends on investors' demand for the country's assets, in particular for the bonds issued by its government. This demand depends on the interest rates that the bonds offer, as well as the risk that the government will default on the bonds. This is called the theory of uncovered interest parity. To see how it works, consider an investor who has 1 Argentine peso to invest. The investor may live anywhere in the world. Assume she will invest today and cash out in 1 year. Let E denote the current nominal exchange rate between the US and Argentina. This means the investor can trade her peso today for E US dollars. Assume that in 1 year, the nominal exchange rate will equal E prime dollars. This means that in a year, the investor will be able to trade 1 peso for E prime US dollars. Or equivalently, she can trade 1 US dollar for 1 over E prime pesos. Let's assume also that the investor has just 2 possible investments for her peso. First, she can buy Argentine government bonds. These bonds promise an annual interest rate of IA. However, repayment of the bonds is not guaranteed. With probability P, the government will repay principal and interest on the bonds in a year. The investor will be repaid her peso investment plus IA pesos in interest. With probability 1 minus P, the government will default. The investor will get nothing. Her expected return is thus the probability P of repayment times the promised repayment of 1 plus IA, plus the probability 1 minus P of default times the payment 0 in case of default. This simply equals P times 1 plus IA. For reference, this expected return is reproduced here as well. The investor can also invest in US bonds. These promise an interest rate of IU. To do this, the investor first trades her peso for E US dollars. She then invests the E dollars in US bonds. In a year, the US government pays her E times 1 plus IU with certainty. There is no default risk. Each dollar must then be converted back to pesos. By assumption, in a year, each dollar may be exchanged for 1 over E prime pesos. Thus, the investor's expected return is simply her return in dollars, E times 1 plus IU, divided by next year's exchange rate of E prime. Summarizing, the investor's expected return from investing in Argentine bonds is the probability P of repayment times 1 plus IA. On the other hand, her expected return from investing in U.S. bonds is the current exchange rate of E times 1 plus IU, all divided by next year's exchange rate of E prime. Since we observe investors buying both types of bonds, they must be indifferent. That is, the expected returns must be equal. We then multiply both sides by E prime and divide both sides by 1 plus IU to obtain a formula for today's nominal exchange rate E. It must equal the Argentine repayment probability of P times next year's nominal exchange rate of E prime times the ratio of the promised gross return of Argentine bonds, 1 plus IA, to the promised gross return of U.S. bonds, 1 plus IU. An important application of this formula is to compute the expected depreciation of the peso over the coming year. To do so, we use the formula to solve for the ratio of next year's exchange rate E prime to today's exchange rate E. We obtain E prime divided by E equals the product of the reciprocal of the repayment probability P on the one hand, and the ratio of the gross U.S. interest rate, 1 plus IU, to the gross Argentine interest rate, 1 plus IA. For example, suppose the repayment probability P is 5/6. Suppose also that the Argentine net interest rate IA is 50%, and the U.S. interest rate IU is 0%. Plugging these values into the formula on the right, we obtain E prime divided by E equals 1 over 5/6 times 1 over 1.5. This turns out to equal 80%. That is, the peso's expected value in 1 year, E prime, is 80% of its current value of E. In other words, the peso is expected to depreciate by 20% in relation to the US dollar. Next, we'll see that the equation yields even stronger predictions if we combine it with the purchasing power parity model of exchange rate determination. In particular, let's assume that we know for sure that purchasing power parity will hold in a year. That is, next year's exchange rate of E prime will equal the PPP exchange rate, which we denote EPPP. Now, let's substitute EPPP for E prime in our formula. With this change, the current nominal exchange rate E equals the repayment probability of P times EPPP multiplied by the ratio of the gross Argentine interest rate, 1 plus IA, to the gross U.S. interest rate, 1 plus IU. It's important to keep in mind that this equation is just an approximation. For instance, if you know that the current nominal exchange rate E is 10 cents, and you compute the expression on the right-hand side to be 11 cents, that does not necessarily mean that the peso is undervalued. Rather, it may simply mean that the markets do not expect purchasing power parity to hold in 1 year, and the markets are usually right. Although it's just an approximation, this new equation yields some very useful insights. For instance, suppose that the Argentine interest rate suddenly rises. Then, by the equation, the nominal exchange rate E must also rise. The peso rises in value, or appreciates, relative to the dollar. To take a concrete example, let us suppose that the default risk is 0. The probability P of repayment is 1. Assume, moreover, that the interest rate in the two countries are initially equal. By the formula, this implies that purchasing power parity holds today. The current nominal exchange rate E equals the purchasing power parity exchange rate of EPPP. Now suppose that the Argentine Central Bank raises its interest rate IA. By the formula, the nominal exchange rate E immediately rises above EPPP. That is, the peso appreciates today. But next year, by assumption, the nominal exchange rate will fall back to EPPP. So the peso appreciates in the short run, but is expected to fall in the long run. Investors are indifferent between Argentine and U.S. government bonds because the higher interest rate on Argentine bonds is offset by the expectation that the peso will fall in value relative to the U.S. dollar. Finally, suppose that the Argentine default risk rises. The repayment probability P falls. Then, by the formula, the nominal exchange rate E must also fall. The peso declines in value. For instance, suppose that initially the repayment probability P equals 1. That is, the risk that the Argentine government may default is nowhere on investors' radar. Suppose also that the interest rates in the two countries are equal. IA equals IU. Then, by the formula, the nominal exchange rate E must equal EPPP. That is, purchasing power parity holds today. Then, a new story appears, suggesting that Argentina may default on its bonds in a year. This lowers the repayment probability P. By the formula, the nominal exchange rate E immediately drops. It is now below EPPP. The peso has depreciated. However, by assumption, the nominal exchange rate must equal the PPP exchange rate in a year. Intuitively, the default risk has risen with no change in the Argentine interest rate. The only way that investors will buy Argentine bonds is if they expect the peso to appreciate. Today's decline in the nominal exchange rate is what makes that happen. Investors are willing to buy Argentine bonds despite the default risk because they expect the peso to appreciate over the coming year. This concludes the third in a series of 3 pre-lecture videos on exchange rates. Thank you for watching.